And we are live. Hello, everyone. Welcome to the Pursuit 365 podcast with your host, me, Shelly Smee, for Real Estate and Finance Fridays. Today, we're joined again by our favorite mortgage broker, Rima Zino. Rima, you mentioned to me a little while ago a really fascinating strategy that I hadn't really thought of before. First of all, because my stepkids are kind of past the age of going to school or having to at least save for it. Their dad made sure they had money for that. But this is a big deal for a lot of people. When you use the different government registered accounts, there's always going to be some, tax implications or putting that money away in a certain type of account that might be locked doesn't allow you to maybe reach some of your other financial goals. So, we'll start off with just a quick comment about the rate change, because I'm like, even though I'm a 28-year realtor, I still have a mortgage on a rental property. And the first thing I did yesterday was go to my Scotiabank account and see if the rate went down. And of course, it didn't go down right away. So this very minute movement in the rate down, how do you interpret it as a mortgage professional?
Thank you so much, Shelly, for having me. Yeah, this is definitely a great time to be in the market and seeing how the changes are evolving. First of all, for the rate change, yes, it is a big deal that we actually getting started. As far as the money numbers, it's 15. It's about $15 per 100,000. So yes, it is a good start, but it's not that huge that say we. But yes, it is good start to get going, and hopefully by the end of this year, we still have 4 announcements to go through, and hopefully the prediction goes. But I'm not in the business of prediction. But anyway, it's about 3.25. Still, we possibly can see this year reduction, which is great news for variable rate clients, for the home equity line of credit and line of credits in general. So that's kind of in that niche. As far as the market concern, we actually, most clients going through the fixed rate for the shorter term, because we still believe the economy will take time to get recovered, and plus all other factors that creates those movements between or in the variable rates. It's still more safe to go with the shorter term fixed rate and see how the economy actually evolving and how stable those costs are we're going to see.
Exactly, because from my point of view, when I'm talking with clients, especially first-time home buyers, or downsizers that are heading into a fixed income period of their life, you need certainty. And, you may save a half a point 2 or 3 years from now on a variable. But for today, when you're looking at crunching the numbers today and qualifying today, the certainty, I think, is a lot more reassuring to people than the hope that they might save a few dollars down the road when we don't really know what that looks like. One of the other commentators in the finance space that I listen to regularly was quite surprised that Canada actually made a move different than what happens in the United States. Do you think, this might be putting you on the spot, but do you think that Canada is finally sort of taking some independence from what's happening financially in America, or is this just sort of a one-off of Canada making a move before the States, the Fed, made a move?
Mm-hmm. I believe it's again it's economy based, and Americans still in the situation when they spending more than actually they earning, and Canadian, as we know, more conservative, very down to earth to make sure they actually can pay their mortgages first before they buying a boat.
So I think, as well as being very friendly and saying sorry all the time, or maybe a little bit more risk averse than
Yes,
our neighbors to the
100%.
south.
Yeah, yeah,
Awesome.
100%.
Awesome.
Even if we see the late payment delays or some with payments not getting made on the mortgages, actually Canadian market, Canadian consumers much more conservative, and I believe it's 0.18 compared to 1% something on the American side for the late mortgage payments. Yeah.
Excellent. Well, I guess in your sphere, you're always getting a lot these reports on a weekly, maybe even daily basis of where markets are heading and what consumer trends are. One of the things that we talked about briefly in a conversation was an interesting idea for saving for your child's education. And, much like long-term planning isn't necessarily something people do well at the beginning of their, the beginning of their lives together, or even if you're a single parent, this is something that really is a long game. I mean, from the time your child is born to the time they hopefully are launched and off to university, you've got, between 17 and 20 years to plan for this expense. Speaking slowly, because I know you get excited about this topic, can you explain the concept of using a rental property, or using your property as the savings vehicle, rather than having to put it all into a government funded RESP?
Yeah, so that's definitely a very amazing topic that I'm promoting recently with my clients. Just to plant that seed as far as the education goes. And the idea is over 15-year term, if your kid is about 3 years old when you opening up that RESP, compare if you buying rental property. So yes, the one of the biggest downs about the rental property potentially could be down payment, but we not necessarily need to buy the property within Vancouver area or large cities that you need very substantial down payment. You always can look at the properties outside of the big cities and definitely go within between 300 to 400 or something in between range of properties, or even to go outside of the provinces in order to manage that small down payment. And on top of it, nowadays, people not getting married that early in their lives, they also have parents that potentially very close to retirement and have very large equity that they really want to help kids or grandkids to succeed in future. So again, if we're talking about family wealth, generational wealth, potentially that down payment can be very easily resolved between the parents and the and the grandparents, so that can be resolved. So as far as the calculation goes between RESP over 15-year term, you totally saving with the government funds and whatnot about $81,000, and you have
What is that based on, a monthly contribution?
monthly contribution about $208 a month. Yes. Okay, nowadays, with the education and inflation and kids taking a little bit longer time, my daughter on year 6 in her university, hopefully another year, and it's going to be done. But regardless, it doesn't cost today $81,000 to complete that education. If we're talking out of the residency, the foods, the books, everything that involves, it more close to maybe 140,000 over that period of time. Now, while your RESP is only $81,000, so you still need to count with that gap to complete. Now, if we comparing that to the same period of time, 15 years of RESP or holding a property for that period of time, 15 years, the property appreciate within between 7 to 10 years about 50%. So if you bought a property for 300,000, that property 15 years from now can be above 700,000 in a very conservative 3 to 4% year over year. And we talking in Vancouver area or just in general market today, it's about actually above 7%. So if we compare your RESP 15-year term with the $81,000, or compare your holding a property that you can have after 15 years, 600,000, which is about 4 to 5 times higher based on the inflation, plus the tenant servicing you this mortgage. And in addition to that, after 15 years, as a parent that put that down payment from the home equity line of credit, you actually can take this money back as a principal after your kid or yourself refinancing after 15 years. So definitely it is a huge strategy to go through, but I just want to give very high point that RESP compared to rental property, it's much more beneficial to go with the rental property as far as finance is concerned. And on top of it, it also can be tax free and without any limitations compared to
So,
RESP.
so I'm just going to play pundit here. What about, I mean, we don't know what's going to happen with the election or whether the new rates for disposition and capital gains are going to stick, and what they could be 15 or 20 years in the future. I guess we're really talking about holding a property. And I think one of the things that an investor, as opposed to somebody just maybe having one extra property, the difference is the investor does really see the long game. I know right now in BC, there's also a lot more stringent rules for landlords and tenants coming in. So, when somebody's going to embark upon having an investment property and dealing with tenants, what about all the costs that are involved over the years? If you have a property manager and you have, general repairs and maintenance between tenants, do you suggest having a property manager? Because I mean, if you're going to buy something that's out of your market area, you're not really going to be easily available to deal with it. Do you think there is a sort of set it and forget it formula to owning investment properties?
The most important part when we're talking about the investors and starting, I'm calling first time investors, is definitely you have to have the team that will support you and take you through the whole process and stay with you after. Which most of the time our relationship starts after we closing the mortgage, after we closing any sort of purchases. So the idea would be, yes, you can have a property manager, but at the same time, as most of the things right now, pretty much remotely, if there is any issue with the property, you simply reaching out to one of the local trades and asking them to approach the property. You're also making sure you have actually a good tenant that you can rely to have a good care, to take a good care of this property. And the same as you hiring employees, the same way you can hire, you actually filtering and going through the interviews with the tenants to make sure they have good income, good credit, and all other information that is involved in that process. Yes, everyone deserve the opportunity for the rental. It's not only we filter in just the top tenants, but at the same time we managing our risks.
Right, because I think some of the chatter that I've been hearing in the industry right now, are there are some properties, especially the one-bedroom units downtown, and some other traditionally investment-held properties where either getting ahead of the recapture, the new rate that people may be subject to, or just having, an unfortunate experience with not a great tenant, or trying to self-manage a property and it's just, too stressful. I do believe, I've had a couple younger people ask me, hey, I'm thinking of getting into the real estate market. And a property manager is a different skill set and a different mindset than necessarily a salesperson. That's what I've come
Correct.
to realize in my managing broker role and in just actually having both licenses at one point in my career. Picking a property manager, I think, is actually almost more important than picking the tenant.
That's true as well.
Do you find that if somebody does want to self-manage their properties, what kind of, I mean, I know that you're an investor and that you do quite well with that. What are some of the things that you look for as an investor in a property? What are some of your criteria?
So my criteria, because as an investor, I'm my idea is a passive income when I will decide to retire. So that's kind of my number one goal, is not buying a property to flip after 2-3 years, actually to hold at least 10 to 15 years. And from that point, it will be a decision when we actually depleting the property or leaving for a family wealth generation income.
Right, right. So this is part of your bigger strategy. This isn't just a sort of a willy-nilly one-off, oh, let's go buy an investment property and try out being a landlord. This is part of your whole investment portfolio diversification.
Yes, and as far as the rates concerned, that's yes, 5 years ago compared to now, which we're going to have about 2 points above the previous rate. But we don't need to forget that a mortgage 5 years ago was a mortgage five. Now, after 5 years, it was actually much lower. And say it's always as a strategy, I'm suggesting to my clients, if needed, we actually can stretch back to that 30-year amortization in order to maintain that lower cash flow, and that's actually helping to maintain that property moving forward. So there is lots of strategy to compare, and let's say we're taking right now only very short 2 or 3 year term. After 2-3 year term, in hopefully the market and the economy will be much better, we can actually stretch back or just go over to 20 years amortization to maintain that. But as an investor mindset, it's always the cash flow is number one and less of what is my rate, because from cash dividend perspective or rental income perspective, you're also working towards how much you actually can deduct in order to maintain your personal taxes as well. So it's from the lender perspective, it's always important to understand the full aspect of to holding a property, how much you actually benefit from it from the personal tax perspective, and to having the property that the tenant actually servicing your mortgage.
Right. And over the long term, being in it for the long game. I think that's one thing that is really challenging in the Vancouver market or the Lower Mainland market. We've had so much flux. We've had so much transient, the transient nature of people coming and going. And certainly we've had the private markets, the investor markets servicing a lot of the need for rental housing. And, I think in some ways that as more investors have decided to get out of that stream of investment, and not enough building going on and a huge amount of immigration, we're in a shortage of rental housing across the country. So it's like being a landlord could be your patriotic duty, but for some people it can also be very daunting. So I really appreciate you shedding some light on some of the positive aspects of how it can fit into your long-term portfolio, and not just thinking of it as, I'm going to buy this, I'm going to have it there for, a couple years, and then I'm going to get out of it and get into something else. Because it just does seem to me there has been a very short-term view in many cases for purchasing properties for, say, rental condos downtown or things like that. People tend to get in and out of them a little more quickly than you would expect. And maybe those aren't true investors. Maybe those are just people that have dabbled and didn't quite have the right guidance to figure out their long-term strategy. So
It's
thank
the
you for
same.
that.
Yes, it is the same with the stock market. You're not going into this to go to stock market or to become an investor in different areas. It's simply to do your research to understand if it fits to your goal. It's yeah. So it's just, I know I might be a little bit, don't have a third opinion, but real estate is definitely fits and more solid compared to the stock market that you wake in the morning and you don't know what to expect.
Well, people always need a place to live.
That's true.
People always need a place to live. And, I think just from my own experience, one of the things that is difficult for people that are long-term tenants is the fact that, like, for instance, I have a client that they had been living in the same house renting for over 10 years. And they were faced with the fact that that house sold. And I'd have to say the property manager there was pretty hands off. They fixed things that needed to be fixed when they needed to be fixed, but they didn't do anything to really improve the property, to the extent that when the repairs started to get too much, the owners of the property decided to sell. Meanwhile, my clients had been in there for over 10 years. And when they looked at, and I think they'd maybe had one rental increase in 10 years. And when they looked at what they would need to be paying for rent to keep their kids in the same school catchment, it was a shock. And I mean, I had been saying to them all along for the last 10 years, you guys should be getting into something. You guys should be getting into something. But they were very aggressive in savings and doing other investment strategies, and, felt very adamant about that. So when this happened and they finally realized that for what they'd pay for rent and for all the money they'd saved in the last 10 years, they might actually be able to get into a property. Thank you very much. You were able to help them out with that. But, that is the sort of flip side of being a tenant and having a landlord that also, for them, it was great. They didn't get rental increases hardly at all over 10 years. But then when it was time for them to move on, it was such a huge shock to see where the market had gone for rentals in the last 10 years. So
And for
I
my
think
point,
as a landlord, as much as you want to be nice and you want to keep good tenants, you need, if you're going to self-manage your property, you really have to understand the residential tenancy act, because the ability to increase the rent to keep up with inflation for your own costs, and the ability to deal with a tenant that might get behind, or deal with a tenant that ends up having some personal problems that, you know, all of a sudden, there's issues with that tenant. It is a very challenging time in the market to deal with issues when they come up. So, um, do you think that somebody should probably interview property managers before they even buy a property, and just know who their team's going to be going in? Or, because I get this question a lot. A lot of people, they think they want to be an investor, but they're just really, all they're hearing is negativity in the media about, you know,
holding the
tenants
property, yeah.
issues. Yeah.
Again, as I mentioned, it's always start and ends with the what type of team you're working with. You have to surround yourself with a great team of real estate agent, mortgage broker that can, because we in the business of day in and day out in the business of the real estate. So as an investment. As an investor, you may not necessarily know what type of yeah, should we cut that part?
Yeah, no, it doesn't get edited. What happened is, my is going off in the other room, and the dog's kind of freaking out.
Okay.
So
Yeah,
I
so
just shut the door. The joys of live studio recording in your home office at home.
yeah, so as an investor, you always start with a great team, because mortgage broker and real estate agent, they we in the market, in and out, day in and day out. So at the same time, we have the right people that already interviewed, we're already working with them. So we definitely can provide the referrals in order to continue to maintain great service for our clients. It also goes with the real estate agent, with the lawyer, with the appraisal, or and the inspection person. So all these parties, we already, as a team, we working together, and they and can refer to the right property manager and to the other services that
Right.
actually
And I think
associated.
and I think an accountant that is well versed in all of the allowable deductions,
100%.
and
Yes,
someone who may not just be an accountant, but also the family estate planning type idea. I think one thing people forget, perhaps, or maybe they don't forget, and I just need to do it myself, so I'm putting myself in that category, is when you have an additional property, or any property for that matter, that you have your wills done. That,
100%.
when you're going to add a property to your portfolio, if God forbid something was to happen to you, you need to have a plan for getting out of that property, and or what happens to not just your principal residence, but to your portfolio, if something were to happen
Involved.
to you.
Yeah.
And do you suggest having that sorted out with the bigger picture of your whole estate planning?
Yes, you have to have your living will that's definitely describe all these points, and it is very important to bring this up to the table. And it's not only stands with the property and estate planning. It's also start with even a password to your computer, and to allow the family members know the other passwords to other softwares, because as of today we all managed by the online life. Another point I just want to bring up, as far as the when we comparing rental and first-time home buyers, it is very important. In my very first discovery call, I always remind them, if they keep renting, let's say for another 3 years compared to buying right now, the average rate right now is about $2,500 a month. Over 3 year term, it's 90,000. And if they hold and rent, or compared to that timeline when they buying with the very small down payment. So it's also very important to bring this up. And when I'm showing the clients, actually, if they continue to rent, their net worth continues to stay zero, and that 90,000 goes to pay out someone else's mortgage. So either they pay the rate of 5% or 4.7 right now, compared to 100% they pay in interest when they rent it.
Right, right. Well, one of the things I love about you, Rima, is that your explainer videos with your incredible skills in Excel spreadsheets, doing the comparisons, is super helpful. And I really look forward to our next chat. We're going to keep it short and sweet today. And in the notes below, you will see information on how to reach out to Rima. But Rima, if people do want to reach out to you, what is the number one best way for them to get a hold of you?
So again, they can reach out across any platforms through Rima Zino Mortgages, and say, just Google and I will be on the first page.
There you go. Well, thank you so much for joining us today, Rima, and
Thank you.
you have a great rest of the week.
Same for you. Thank you so much, Shelly, for having me.
Okay, take care.
Bye bye.
Bye.